What's up, subbies? Welcome back to my channel, guys. So on to today's video, I'm going to be sharing with you guys some of the investment terms that I believe that are basic, and I believe that that's where you can start. I wanted to make this video and start giving you guys some of the investment terms. Maybe once a video I'll make 5 investment terms, give you an examples so that you guys can not an example, give you example so that you can understand. And I did this because most people keep on asking me, hi Itumele, where can I start? Look, where can I start? How do I start to invest? So I think it's better if you start learning the investment terms so that when you're reading about maybe investment articles, you know, because they're always using the investment language, investing language. So I think you should start to learn about investment terms so that you don't get confused when you're reading about these articles, which is also good, guys. Do read investment articles, which is good. You can get them from Business Tech, you can get them from MoneyWeb if you're in South Africa, you can get them from Yahoo Finance, Investopia. I don't know if I'm pronouncing that right, but yeah, look into those websites because you will get so much information. You will know which certain company has decreased, which company is facing a backlash. Those kind of things are really important before you want to invest in a company. So I'm gonna give you at least 4 terms. I hope that I give you 4 terms because I don't want to make this video long. I just want to keep it short for you guys because I know it's boring to learn and it takes a long time. So the very first term I want to talk about is intrinsic value. Intrinsic value, some people call it fundamental value. It basically means that the value of the company, how much the company is worth, not looking at the external but looking at the internal, looking at its assets, its earnings, all those things, how the company is worth. That's why they call it a fundamental value, because it talks about the company's assets, earnings, revenue, liability. You can name them all. So that's what intrinsic value is. So I hope you understand what intrinsic value is. So I wanted to talk about I wanted to explain to you what intrinsic value is so that you can understand the second term that I'm going to explain it to you guys. So the second investment term I want to talk about is margin of safety. So margin of safety is it's an investment principle where you buy shares below the intrinsic value. That's why I explained intrinsic value before I explained margin of safety. So let me give you an example of margin of safety. What is margin of safety? So let's say let me make an example with Capitec. I know I'm always making an example with Capitec. So let me make an example about Capitec. Let's say Capitec, its intrinsic value is 1,700 rands, right? Not its market share. There's a difference between an intrinsic value and its market share. So this intrinsic value that is 1.7 is what actually the company is worth, its value. So let's say the market share price of Capitec is 1.1 at this moment, right? So it's 1,100 rands and its intrinsic value is 1,700 rands. So here, this space here between 1.7 and 1.1, it's your margin of safety. So what it means that if you want to limit your risk of losing money, don't buy at 1.7, buy around this space here between 1.7 and 1.1. So if you're gonna buy your shares at 1.1, it means that you're limiting yourself from getting more risk if the share price decides to decrease. You understand? So if the share price decides to decrease to 900, it means 900 rands. It means that you maybe lose 200 rand. Other than buying the intrinsic value where it was at 1.7, what the company is actually worth at 1.7. So if the market share price drops to 900, you're gonna lose a lot of money, other than losing just the 300 where you bought it at discount. So using margin of safety, you are limiting yourself from losing more money. It doesn't mean that you're not going to lose any money when the share price of a company drops, but you're just limiting yourself from losing more money, other than buying it from the intrinsic value, which was 1.7. I hope that you understand what I mean. I really do want you guys to understand the margin of safety, because it's important to know margin of safety. But if the market share price keeps on appreciating more than the intrinsic value, then you would have to buy it at the intrinsic value or at that market share price if it keeps on increasing and it's never gonna come back. So that's what margin of safety is, and that's why Warren Buffett calls it the cornerstone of investing, because it limits you from losing more money. So that's what it is. So the third investment term I want to talk to you about is EPS. EPS is earning per share. I talked about it on my previous video when I was talking about the company that I purchased that are listed on the New York Stock Exchange. So EPS is what the company earns per share. So it's in the name, earning per share. So that's what they get after selling one share. So you can calculate it by taking the net income of the company, you minus it with the dividends, and you divide that with the outstanding shares, so that you will get your EPS, how much the company earns per share. But if you don't want to do that, they always give you, when they give you the fundamentals of the company. Yahoo does that, MoneyWeb also does that. When you're looking into the company's fundamentals, they give you that as well. So I want to talk to you about EPS because I want you to understand the next investment term that I want to talk about, which is PE ratio. So a PE ratio is a price to earning. So what it basically means is it's a ratio that values the company. So if you want to value the company, you can also use the PE ratio as well. So you can do that by taking the current market price and you divide it by the EPS that I talked to you about, which is the earning per share, and then you will get your PE ratio. And also the PE ratio, they also give it to you, so they already calculate it for you and give it to you. Yahoo Finance also do that, MoneyWeb also do that. Most of these websites that deals with investments, they do give you a PE ratio that is already been calculated, and the EPS as well. They'll give you so many things that are already calculated, you just have to know. But if you want to make sure, you can do it on your own as well, which is also good, so that you can double check if it's true. So companies like Amazon have the highest PE ratio. Amazon has a PE ratio of 75. So an average PE ratio, it's supposed to be around 20-25 right there, which is companies like Alibaba, like Google, like Investec PE ratio is still like, it's 19, I think. Yeah, that is the average PE ratio. But the PE ratio that has like 75, which is what Amazon has, so that we call it an overvalued PE ratio. So that can mean two things. It can mean good, it can mean bad. So the first one, which is good, it means that Amazon is growing at its fastest pace, which is really good because they'll be getting more earnings, which is good because by the time you want to sell your shares, it means that you'll be getting more returns, right? Also, it can mean bad because what if Amazon cannot pick up the pace and grow its earnings? So a low PE ratio, it also has two sides. It can be good, it can be advantage, and it can be a disadvantage as well. So when a low PE ratio is an advantage, it means that investors can buy share price at a discount, so that whenever the share price appreciates, that's when you make your profit because you bought it at a discount. That's why they say buy low and sell high. So when you see a company that is discounted from its intrinsic value, then go for it, because it's the right time for you to buy it, because when it climbs up, you will be able to make more profit. You understand? But then again, a low PE ratio, it will mean that the company is not growing as much as it has to, and it's just not doing great. So I also want to talk about people who bring their emotions into investing. Guys, if a certain company's share price is dropping, like Capitec right now, its share price is dropping, it's not the right time to sell your shares. When you sell your shares, when a company is dropping, the share price is dropping, you are going to lose money. If you're not selling your shares and the share price is dropping, you're basically not losing money. You're basically not losing actual money, because that company is going to make a turnaround, and when it makes a turnaround, it's going to appreciate again. Unless there's a company that it was reported that it's going to go bankrupt, then please do a stop loss and take out your money. But if a certain company is just dropping, it means that there is a possibility that it's going to make a turnaround and appreciate again. Don't ever go into investing and selling your shares when they're dropping, because you are going to lose actual money. So wait for that company to appreciate, and then that's when you can sell your shares if you want to sell your shares. So thank you guys for watching. I hope that this video was helpful. That's what I'm always aiming for. Please give this video a thumbs up, subscribe guys, join the family, and comment whatever that you want me to talk about. Any investment terms that you feel like you don't understand, you want me to talk about it, and I will do so. Thank you guys for watching. I'll see you next week.